You have been lied to your entire life. You've been told that buying a house is the ultimate financial goal, and that renting is just throwing money away. But here is the brutal truth about the 2026 housing market: that old-school advice is actually keeping you broke. When you factor in the math of a $500,000 house today, the reality is terrifying. Today, we are going to look at the hidden costs that realtors pray you never calculate. I'm going to show you the exact math of why being house poor is a financial death sentence, and why renting, yes, renting, might actually be the secret cheat code to building wealth faster. Let's talk about the pressure. You feel it in your chest, don't you? Society has handed you a very specific script for success. You graduate, you get a secure job, you get married, and you buy a house with a white picket fence. If you deviate from that script, people look at you like you are failing at life. Every time you open Instagram or TikTok, some 22-year-old real estate guru is screaming at you to house hack a duplex and build a rental empire. Every Thanksgiving, your parents or your uncles ask when you are finally going to settle down, stop wasting your money on rent, and buy some property. They look at your apartment and treat you like you are making a massive, irreversible financial mistake. They constantly repeat that classic, worn-out phrase, "Rent is just paying someone else's mortgage." Hearing that over and over again puts your brain into a constant state of panic. You feel this intense, burning anxiety that you are falling behind your peers. You feel like you need to scrape together every single penny you have, drain your hard-earned emergency fund, and jump into the housing market before the door closes forever. You are operating in pure survival mode, driven entirely by FOMO, the fear of missing out. But what if the door they desperately want you to walk through leads straight to a financial prison cell? The traditional American dream was built for a completely different era. An era where an average salary could comfortably pay for an average home in 5 to 7 years. But in 2026, the math has fundamentally broken. We are playing a completely different game, but everyone around you is still trying to use the old rulebook. When you rush to buy a home you can barely afford just to appease society and your family, you are trading your liquid freedom for an illiquid concrete box. You go from being financially flexible to being exactly one broken HVAC system, one leaky roof, or one unexpected property tax hike away from crushing, high-interest credit card debt. The reality is, for the first decade of a 30-year mortgage, you do not own the house owns you. Before you lock yourself into a 30-year financial contract that dictates exactly where you live, what jobs you can take, and how much career risk you can tolerate, you need to see the actual numbers. Because when we strip away the emotion, the beautiful granite countertops, and the neighborhood prestige, real estate is just a cold, hard math equation. And right now, for millions of everyday people, that equation equals bankruptcy. Are you ready to see what the bank is actually doing with your money behind the scenes? Let's dive into the generational lie. To understand why you constantly feel so behind financially, you have to understand a concept I call the generational lie. Every single time you mention how impossibly expensive life has become, someone from an older generation will inevitably jump in with the exact same advice. They will look you dead in the eye and say, "You just need to stop buying expensive coffee, save up for a down payment, and buy a nice little starter home. Renting is just paying someone else's mortgage." Here is the thing. They mean well. They really do. They are giving you the exact blueprint that worked perfectly for them. But there is a massive problem. They are giving you a 1996 map to navigate a 2026 financial war zone. Let's look at the actual math of their era versus ours. Your parents and grandparents bought their first homes in a completely different financial universe. Back in the 80s and 90s, housing prices were strictly tied to local median incomes. It was a localized closed loop. If the people working in a specific town made a certain average salary, the houses in that town cost a proportional amount of money. In 1996, the average home cost about 3 to 4 times the average yearly salary. You could literally work a standard middle-class job, save diligently for just a few years, and comfortably buy a 3-bedroom house to raise a family in. The math fundamentally worked. The system was designed for the average worker to win. But today, the math is entirely broken. We have seen massive runaway housing inflation completely detached from wage growth. Your income is climbing a staircase, but housing prices are taking a private jet. Why? Because housing is no longer just local shelter. It has transformed into a global, institutional investment vehicle. When you put an offer on a starter home today, you are no longer just competing against the nice couple down the street. You are competing against multi-billion-dollar Wall Street firms, aggressive hedge funds, and foreign capital that can sweep in and pay entirely in cash over the asking price. Because of this hostile takeover, that historical price-to-income multiplier isn't 3 or 4 anymore. In many cities, the average home now costs 8, 10, or even 12 times the average local salary. And this is exactly where the psychological gaslighting comes in. Society tells you that the reason you don't own a home is because of your daily spending habits. You are told it's the avocado toast, the streaming subscriptions, or the occasional dinner out with friends. But let's be brutally honest for a second. Skipping a $5 coffee is not going to close a $300,000 gap in purchasing power. You cannot budget your way out of a broken macroeconomic system. You feel broke because society is aggressively telling you that you should be able to easily afford something that has been mathematically engineered by institutions to be completely out of your reach. The traditional advice that made your parents comfortably middle class is the exact same advice that will lock you into the lower middle class today. If you force yourself into this inflated market by draining your entire life savings just to barely afford a monthly mortgage, you aren't building wealth. You are just signing a 30-year contract to be permanently house poor. We are constantly told that renting is paying someone else's mortgage. But when you actually buy a house today with a 30-year loan, wait until you see who you are really paying. It's time to pull back the curtain on the banking industry's favorite legal scam. Let's break down the amortization trap. Let's talk about the 30-year mortgage. Society treats it like the holy grail of financial maturity. You sign a massive stack of papers, you get the keys, and you proudly announce to the world that you are officially a homeowner. But let's look at the math. When you take out a standard mortgage, you aren't actually buying a house right away. You are simply renting money from the bank. And the rent you pay on that massive pile of money is called interest. Here is the dirty little secret of the banking industry. They do not charge you interest evenly. They use a mathematical system called an amortization schedule. Amortization is a fancy, complex-sounding banking term that basically translates to front-loaded pain. It is a system mathematically designed to keep you on the financial treadmill for as long as humanly possible. When you make your monthly payment of, let's say, $2,500, your linear human brain assumes that a huge chunk of that is going towards actually owning your property. You picture yourself buying the kitchen in year 1, the living room in year 2, building your wealth brick by brick. But the bank structures the loan so that for the first 10 years, almost your entire monthly payment goes straight into their profit columns. Out of that $2,500 payment, over $2,000 might go exclusively to interest. Only a few $100 actually goes toward your principal, the part of the house you get to keep. You are throwing thousands of dollars into a financial black hole every single month, just for the privilege of holding the keys to the front door. For the entire first decade of homeownership, your equity growth moves at a microscopic, agonizingly slow pace. If you look at your loan balance after 5 solid years of perfectly on-time, stressful payments, you will be absolutely sick to your stomach. You will have paid over $100,000 to the bank, and your actual loan balance will have barely moved an inch. You might proudly tell your friends and family, "I own a home," but realistically, the bank owns the home. You are essentially a tenant, and the bank is your landlord. But there is a massive catch. Unlike a normal renter who can call the landlord when things break, you don't have that luxury. You just have the legal obligation to fix the roof when it inevitably caves in. The heavy interest of the amortization schedule is just the tip of the iceberg. It is the part you can see, but the interest is only the beginning of the trap. What comes next is what truly suffocates the middle class and destroys their ability to invest. Let's dive into the underwater part of the iceberg. Let's talk about the phantom costs. If the massive interest from your amortization schedule is the tip of the iceberg, these costs are the jagged, heavy block of ice lurking underwater, just waiting to sink your financial ship. Real estate agents love to compare a monthly rent payment directly to a monthly mortgage payment. They pull up a calculator and say, "Look, your rent is $2,000 and this mortgage is exactly $2,000. Buying is a no-brainer." But that is a dangerous, fundamentally flawed comparison, because they are conveniently leaving out the completely unrecoverable, deadweight costs of homeownership that I call phantom costs. These are the expenses that drain your bank account, but add exactly $0 to your net worth. First, let's look at property taxes. People love to say that when your 30-year mortgage is finally paid off, you get to live there for free. That is a complete myth. Property taxes are essentially permanent rent that you pay to the government. And guess what? As your home value goes up due to inflation, your property taxes go up right along with it. If you think you truly own your house free and clear, try not paying your property taxes for 3 years and see who actually owns that land. Next, we have homeowners insurance. Over the last few years, insurance premiums have absolutely skyrocketed. In many areas, it is becoming a massive monthly burden. Add on top of that your HOA fees, homeowner association dues that legally can and will be raised at any time to cover neighborhood expenses. But the absolute biggest killer of middle-class wealth is maintenance. The golden rule of real estate is that you must expect to spend 1 to 2% of your home's total value every single year, just to keep it from falling apart and losing its value. Let's do the math on a $500,000 house. That is $5,000 to $10,000 a year in completely unrecoverable expenses. That is an entirely new roof. That is a blown water heater in the middle of winter. That is an unexpected foundation repair. It is never a matter of if these things will break, it is just a matter of when. This brings us to the most important rule of the housing market. You need to memorize this, write it down, and remember it the next time you feel guilty about renting. When you rent, your monthly rent payment is the absolute maximum you will pay for housing that month. If the refrigerator dies, you make a quick phone call, you go to sleep, and someone else pays thousands of dollars to replace it. But when you buy a house, your mortgage payment is the absolute minimum you will pay for housing that month. It is the floor, not the ceiling. So, how does this actually play out in real life when we compare a renter investing their savings against a homeowner paying all these hidden fees? The numbers I'm about to show you will completely change how you view real estate forever. It's time to run the ultimate case study. Let's put everything we have talked about to the ultimate test. It is time to run the exact numbers. No more theories, no more guessing, and no more listening to society's outdated advice. Meet our two test subjects, Homeowner Harry and Renter Rachel. They are exactly the same age, they make the exact same salary, and they have both worked incredibly hard to save up exactly $100,000 in cash. They are standing at a major financial crossroads, and the choices they make right now will dictate the rest of their financial lives. Let's start with Harry. Harry desperately wants the American dream. He wants the title of homeowner and the societal status that comes with it. So, he goes out into the market and finds a nice $500,000 house. He takes his entire $100,000 life savings and hands it over as a standard 20% down payment. In an instant, his bank account drops to zero, but he gets the keys. To pay for the rest of the house, he takes out a $400,000 mortgage at a 6.5% interest rate on a traditional 30-year timeline. Let's look at his monthly bill. His base principal and interest payment is $2,528. But remember the amortization trap we just talked about? Out of that monthly payment in year one, an absolutely staggering $2,166 goes straight to the bank as pure interest. Only about $360 actually goes toward owning his home. But Harry's financial bleeding doesn't stop there. We have to add the heavy underwater portion of the iceberg, the phantom costs. His property taxes are $500 a month. His homeowner's insurance is $150. His neighborhood HOA fee is $100. And following the standard maintenance rule, he needs to set aside $416 every single month just to fix the things that inevitably break. When you add it all together, Harry's true total monthly cost to simply survive in this house is $3,694. That is his floor. That is the absolute minimum he must pay every 30 days to keep the bank from taking his property. Now, let's look at Rachel. Rachel understands the math. She decides to rent a virtually identical home, maybe even right down the street from Harry. Her monthly rent is exactly $2,400. She adds a simple $20 renter's insurance policy to protect her belongings. Her total monthly housing cost is exactly $2,420. That is her ceiling. If the roof starts leaking or the furnace explodes in the middle of winter, she doesn't pay a dime. She simply makes a phone call, and her landlord absorbs the cost. Now, let's look at the incredible financial advantage Rachel just created. Because Rachel is renting, her monthly housing cost is $1,274 cheaper than Harry's. We call this difference the gap. And remember her original $100,000 in savings? She didn't hand it over to a bank for a down payment. She keeps it fully liquid, invested in a standard S&P 500 index fund, returning a historical average of 8%. But she doesn't stop there. She takes that $1,274 monthly gap and she automatically invests it into that exact same stock market fund every single month. Harry is trying to build his wealth slowly through drywall, interest payments, and bricks. Rachel is building her wealth rapidly through compound interest and the stock market. So, who actually wins? The answer in year 10 is going to absolutely shock you. Fast forward exactly 10 years. A full decade of life has happened. Harry has been aggressively mowing his lawn, cleaning his gutters, and faithfully sending that massive mortgage check to the bank every single month. Rachel has been renting, living her life, and letting her automated investments run quietly in the background. Let's look at the score. We will assume a historically healthy 3.5% annual appreciation on Harry's house. In 10 years, his original $500,000 property is now worth an impressive $705,000. Because he has been paying down his mortgage for a decade, his loan balance has finally dropped to $343,000. If Harry were to sell his house today, his total equity, his actual net worth tied up in the property, would be $362,000. That is a solid number. Harry feels like a winner. He looks at his house and sees a giant piggy bank. But there is a massive catch. That money is trapped behind drywall. It is completely illiquid. He cannot use it to buy groceries. He cannot use it to start a business. And he cannot use it to invest in a new opportunity unless he literally sells the roof over his head or begs the bank to loan him his own money back at a high interest rate. Now, let's look at renter Rachel. While Harry was busy draining his savings to replace a dead water heater in year 4 and fixing a cracked foundation in year 7, Rachel was letting compound interest do all the heavy lifting. Her initial $100,000 combined with her strict discipline of investing, that $1,274 monthly gap, has been compounding in the market at an average of 8%. At year 10, Rachel's liquid stock portfolio has grown to $449,000. Let that sink in. She is ahead of Harry's net worth by exactly $87,000. And she has not spent a single Saturday afternoon arguing with a homeowners association paying a plumber or stressing about property tax hikes. But year 10 is just the warm-up. Let's jump to the climax. Let's talk about the 20-year mark, because this is where the math becomes absolutely terrifying for the people following traditional advice. The compound interest curve is exponential. It starts slow, but eventually it goes completely vertical. At year 20, Harry's house has practically doubled in value. It is now worth $994,000. He has chipped away at his loan, bringing the balance down to $228,000. Harry is sitting on a very respectable $766,000 in equity. Society tells him he has won the game. But then we look at Rachel's brokerage account. Her portfolio has finally hit the explosive part of the curve. At year 20, Rachel's liquid investments have skyrocketed to $1.2 million. Rachel is a liquid millionaire. She has absolute, uncompromised financial freedom. Harry is what we call house rich but fundamentally cash poor. To access his wealth, he has to uproot his entire life, sell his home, pay tens of thousands in realtor fees, and then go buy another expensive home in the exact same inflated market. Rachel, on the other hand, can access her wealth with a simple tap on her smartphone while sitting on a beach. The gap in their net worth is shocking, but the gap in their daily stress levels is even bigger. This isn't just about the math anymore. It is about how this math physically rewires your brain. Which brings us to the most important part of this entire video. Let's talk about the psychology of the 30-year anchor. We've talked extensively about the math, but we really need to talk about the psychology. Because building a better money mindset isn't just about looking at spreadsheets. It's about how you actually sleep at night. When you take on a massive fixed mortgage cost that eats up most of your monthly paycheck, you immediately put your brain into what I call scarcity mode. You become incredibly fragile. When your minimum monthly survival cost is pushing $4,000, a lost job isn't just a minor bump in the road. It is a complete, life-altering catastrophe. An unexpected car breakdown or a medical bill instantly becomes a major crisis. In scarcity mode, your brain is constantly scanning for threats. You are operating in pure survival mode. You have a heavy, 30-year financial anchor tied tightly around your neck, and your primary goal in life just becomes making sure you don't sink. Every weird noise in the basement, every heavy rainstorm, and every new crack in the driveway represents a potential financial disaster that you are solely responsible for paying for. Because of this massive anchor, you lose your greatest wealth-building tool, your ability to take calculated risks. If you find yourself working for a highly toxic boss, you can't just walk away. You have to take the daily abuse because you have a massive mortgage to pay. You can't take a temporary pay cut to pivot to a new career you actually love. You can't start that dream business because the bank expects its massive check on the first of the month every single month for the next 3 decades. Now, let's flip the script. Let's look back at Rachel, our renter who is aggressively investing her gap money. Because Rachel has low, fixed monthly liabilities and a rapidly growing liquid net worth, her brain physically changes. She completely switches out of scarcity mode and steps entirely into opportunity mode. In the financial world, we often joke about FU money. This means having enough liquid cash on hand to simply walk away from any bad situation. When you rent and invest, you build this safety net remarkably fast. If Rachel's local job market completely dries up, she can just pack up and move to a better city. If an amazing career opportunity arises across the country, she breaks her lease, pays a small penalty, and goes. She has 2, 3, maybe 4 years of living expenses saved up and completely liquid. Because of this ultimate flexibility, she walks into salary negotiations entirely differently. She takes career risks differently. Paradoxically, people with large amounts of liquid savings often make significantly more money in their careers because they aren't afraid to ask for it. They project quiet confidence, not financial desperation. The psychological freedom of having hundreds of thousands of dollars in liquid cash, rather than having it trapped behind drywall and waiting for a bank's permission to use it, is something most traditional homeowners never get to experience. Buying an inflated house often locks you into a single path, but renting and investing buys you your freedom of choice. So, does this mean you should never, ever buy a house under any circumstances? Let's bring some sanity back to the conversation. Now, after hearing all of this brutal math, you might be thinking, I absolutely hate real estate. You might think I am telling you to never, ever buy a house under any circumstances. But that is simply not true. Let's bring some sanity and nuance back to this conversation. Buying a house is not inherently evil, but we have to stop blindly calling a primary residence a guaranteed financial investment. Buying the house you live in is, first and foremost, an emotional lifestyle choice. You are paying for stability, you are paying for the right to paint the walls whatever color you want, and you are paying to plant roots in a community. Under the right conditions, that is a beautiful thing. You just need to know the mathematical rules of engagement so the bank doesn't eat you alive. If you are going to buy a house in today's market, you need to follow 2 unbreakable rules. Rule number 1 is the time horizon. Do not buy a house unless you know with near absolute certainty that you are going to live in that exact same location for at least 15 years. Why 15? Because as we saw with the amortization trap, it takes about a decade just to break even on the front-loaded interest, the heavy closing costs, and the massive realtor fees. If you buy a house and sell it 5 years later because you got a new job or suddenly wanted a bigger backyard, the math practically guarantees that you will lose money. Rule number 2 is the 28% rule. Your total housing costs must absolutely stay under 28% of your gross pre-tax income. But here is the critical catch that most people miss. That 28% cannot just be your basic mortgage payment. It must include the entire underwater iceberg. It must include your property taxes, your homeowner's insurance, your HOA fees, and a dedicated monthly budget for that 1 to 2% annual maintenance. If you run those numbers and the true total cost pushes 35 or 40% of your income, you are not buying a house. You are buying a financial prison cell. If you are buying a home simply out of FOMO, or because your parents told you renting is throwing money away, or because you want to impress people on social media, you are stepping into a massive life-altering trap. You are sacrificing your youth, your mobility, and your daily peace of mind for a concrete box. True wealth isn't about owning bricks and drywall that constantly demand your time, energy, and money. True wealth is about owning liquid assets that pay you while you sleep. It is about buying back your time, your freedom, and your ability to choose exactly how you want to live your life. Time is the absolute greatest investing tool you will ever have, and it is the only one you cannot get back. Don't waste your 20s and 30s stressing over a broken water heater when you could be building a liquid empire. If this mathematical breakdown changed the way you look at real estate and money, hit the like button right now to let the YouTube algorithm know. And make sure to subscribe to Better Money Mindset for more brutal truths, simple math, and strategies to build real wealth. Let me know in the comments below. Are you currently renting and investing your gap, or did you buy the house? Thanks for watching, and I will see you in the next video.